Hey there, and welcome to This Explainer. Today, we're diving into the absolute wild ride that is the Indian banking ecosystem. We're going to trace it all the way from colonial-era moneylenders right up to the modern digital magic of how your deposits literally multiply within the economy. Seriously, if you've ever wondered how the cash in your pocket connects to the massive global financial grid, you are absolutely in the right place. Let's get right into it. To make sense of all this history and math, we've got a quick roadmap for you. We'll start with the evolution of Indian banking, move into the nationalization era, check out how the whole ecosystem gets regulated, categorize the modern banks we use today, and finally, look at how banks literally create money. All right, kicking things off with Section 1, the evolution of Indian banking from 1776 to 1991. You know, it is kind of crazy to think that the massive, multi-billion-dollar financial institutions we rely on today trace their names back to literal wooden benches. Seriously? The word bank comes straight from the Italian word banco, which just means bench or table. It referred to the actual physical benches medieval moneylenders used in European marketplaces. Back then, it was highly personal, very physical, and honestly, a million miles away from the digital ecosystem we know today. Now check out this rare 1776 note from the Bank of Hindustan. Set up in Calcutta by Europeans, this was India's very first swing at modern banking. But it wasn't exactly a roaring success. This early attempt actually failed. Why? Well, mostly due to a mix of poor management and a huge lack of public trust. People just weren't quite ready to hand over their hard-earned wealth to a formal institution yet. I mean, would you be? So, as you can see on this timeline, early banking in India was super elite and very urban-focused. You had these presidency banks that pretty much only served the British government and wealthy traders. But watch how it evolves. Over the decades, these banks were consolidated, merged into the Imperial Bank in 1921, and eventually, the government stepped in to transform it into the State Bank of India in 1955. Fast forward to 1991, and economic liberalization absolutely blew the doors open for the private and foreign banks we interact with today. Which brings us to Section 2, the nationalization era, or basically, banking for the people. Okay, remember that elite Imperial Bank of India we just mentioned? In 1955, it went through a massive overhaul. It was nationalized and turned into the State Bank of India. And this wasn't just a simple rebrand, it was a total change in mission. The goal was to drag banking out of those wealthy cities and push it deep into rural India to support agriculture and small industries. Almost overnight, SBI became the absolute backbone of the Indian banking system. But here's the catch. Even with SBI expanding, by 1969, there was still a huge problem. Credit was pretty much only flowing to massive industries. Farmers, small businesses, completely ignored. Which begs the question, why did the government, led by Prime Minister Indira Gandhi, suddenly take the drastic step of nationalizing 14 major private commercial banks all at once on July 19, 1969? Well, they basically had to step in to break this corporate monopoly on money. To do this, they introduced something called priority sector lending. This was a game changer because it forced banks to distribute credit evenly across different regions and sectors. For the first time, farmers, small-scale industries, and self-employed folks could actually get their hands on financial support. It was a rapid, massive push for financial inclusion and rural development. Moving right along to Section 3, regulating the ecosystem, or in other words, the rules of the game. So with all these banks running around, someone has to act as the ultimate referee, right? Enter the Reserve Bank of India, empowered by the Banking Regulation Act of 1949. Now, the RBI doesn't deal directly with you and me. Instead, they grant the banking licenses, run intense inspections, and most importantly, force banks to hold on to specific reserves, which you might know as CRR and SLR. Why? To avoid a total banking collapse. And if things do go south, the RBI steps in as the lender of last resort to protect depositors' money. Basically, they are the safety net. All right, Section 4, categorizing modern banks, focusing on public versus private. The foundation of this entire modern setup is the commercial bank. In plain English, a commercial bank is the main bridge between folks who have extra money they want to save and people or businesses who really need to borrow it. It doesn't matter if it's a giant public sector bank, a super agile private one, or a foreign bank operating in India. If they accept deposits and give out commercial loans, they fit right into this category. Now, look at the ecosystem today, and you'll see a pretty fascinating balancing act. On one side, you've got a rural farmer who absolutely relies on the lower interest rates and the massive, sprawling branch network of a public sector bank like SBI. On the other side, you've got an urban tech worker who wants a slick, high-speed mobile app and instant loan processing from a profit-driven private sector bank like HDFC. Both are completely essential. The public banks drive financial inclusion, while the private ones push for fierce competition and digital innovation. Which brings us to our final part, Section 5. How banks create money. This is the process of credit creation, and honestly, it's pretty mind-blowing. Okay, we need to bust a really common myth right now. Banks do not keep all of your deposited cash locked away in some giant vault. They just don't. Instead, they use what's called a fractional reserve system. Because of the rules set by the RBI, banks are only required to keep a tiny fraction of your deposits as cash reserves. That's the CRR and SLR we talked about earlier. The rest of it, they are totally free to lend that out to other borrowers. And this one little mechanism is the actual engine of money creation. Let's break this down with a real example because it's like a giant financial puzzle. Say you walk in and deposit 10,000 rupees into your bank, and the RBI says the reserve requirement is 20%. Your bank holds on to 2,000 rupees and lends out the other 8,000 to a borrower. That borrower goes and spends the 8 grand paying a vendor, who then takes that exact 8,000 rupees and deposits it into their own bank. Now, that second bank holds 20%, which is 1,600 rupees, and lends out the remaining 6,400. That gets spent, deposited again, and the cycle just keeps cascading down through the entire banking system. It's wild, right? And because of this continuous ripple effect, that 20% reserve ratio actually creates a credit multiplier of 5. The math here is surprisingly simple. 1 divided by the reserve ratio of 0.20 gives you 5. So, what does this actually mean for you? It means your initial physical deposit of 10,000 rupees just generated 50,000 rupees of total money circulating in the economy. Every single initial deposit creates new loans, which then create new deposits, expanding the money supply exponentially. So knowing that banks are effectively multiplying money out of thin air every single day, it leaves us with one incredibly vital question. How delicate is the balance between creating just enough credit to fuel economic growth and accidentally triggering a massive, dangerous financial bubble? If banks can literally create money just by lending it, understanding exactly how the RBI tightens or loosens those reserve rules becomes the master key to understanding our entire economy. So the next time you tap your banking app or swipe a card, just remember the incredible journey that money took from a medieval wooden bench all the way to a complex digital multiplier today. Keep questioning, keep learning, and we'll catch you on the next explainer.